If you want to know the true health of the global economy, don't listen to the politicians, and honestly, don't even listen to the Federal Reserve. Watch the boxes. UPS just dropped their fourth quarter 2025 earnings and their full outlook for 2026. And the numbers tell a story that is much deeper than just did the stock go up or down. We are looking at a company that is often called the economy's bellwether. When UPS sneezes, the US economy catches a cold. And looking at this new report released January 27th, 2026, there is a very specific signal flashing red in the US domestic market that every single investor needs to see. Volume is down, revenue is struggling, but pricing power is up. What does that mean for your portfolio? In this video, we are tearing apart this earnings report page by page. I'm going to show you the exact numbers regarding their multi-billion-dollar dividend, the $137 million write-off they tried to bury in the fine print, and exactly what their 2026 guidance tells us about a potential recession. My name is Zuhair, this is Seed to Wealth, and we let the numbers do the talking. Let's get into it. Okay, let's start with the headline numbers. On January 27th, 2026, UPS announced their consolidated revenues for the fourth quarter came in at $24.5 billion. Now, simply seeing $24 billion doesn't help us unless we know the context. Is that good? Is that bad? To understand that, we have to look at the bottom line. For Q4 2025, their operating profit was $2.6 billion. But here is where you have to put on your investor glasses. You'll see two numbers for earnings per share, EPS. The GAAP number, which follows standard accounting rules, is 210. But the adjusted number, the one Wall Street usually cares about, is 238. Why the difference? Why is the adjusted number higher? Well, UPS took some significant hits this quarter. They had a $137 million charge because they wrote off their MD-11 aircraft fleet. Basically, they are retiring old planes. They also had $101 million in transformation charges. This is corporate speak for restructuring, layoffs, or modernization costs. As an investor, I actually like seeing that MD-11 write-off. It tells me they aren't clinging to old assets. They are cleaning up the balance sheet to be more efficient in 2026. Now, I want you to pay close attention to this next part. This is the most critical data point in the entire report for understanding the U.S. consumer. Let's look at the U.S. domestic segment. Revenue came in at $16,756 billion for the quarter. Compare that to the same time last year, 4Q 2024, where they did $17,312 billion. That is a decline of 3.2%. Why is revenue dropping in the busiest shopping season of the year? The report says it explicitly. It was primarily driven by an expected decline in volume. Fewer packages are being moved. That means you, me, and businesses across America are ordering less stuff. That is a clear sign of cooling demand. But wait, there is a twist. Look at the second bullet point in that image. Revenue per piece grew by 8.3%. This is the definition of sticky inflation or pricing power. Even though people are shipping fewer boxes, UPS is charging way more for every single box they do ship. They managed to keep their operating margin at 8.5% or 10.2% adjusted despite losing volume. This is a double-edged sword. It's great for UPS shareholders because it protects profits, but for the economy, it implies that the cost of doing business is still rising significantly. Now, let's contrast the US with the rest of the world. Let's look at the international segment. Here we see a different story. Revenue was $5.045 billion, which is actually up from $4.9 billion the year before. That's an increase of 2.5%. Why is international growing while the US is shrinking? Again, look at the revenue per piece. It increased by 7.1%. But look at those margins. The US segment had margins around 8.5% to 10%. The international segment, operating margin was 17.5%. This is why diversification matters in your portfolio. If UPS was only a US company, this report would look much uglier. The high-margin international business is doing the heavy lifting right now, offsetting the weakness we see here at home. Briefly looking at the supply chain solutions segment, this is their freight forwarding and logistics business. Revenue took a massive hit. It dropped to $678 billion from over $3 billion the previous year. Operating profit also dipped slightly to $263 million. This usually happens when global freight rates normalize. During the pandemic and the years after, freight rates were sky high. Now that supply chains have untangled, they can't charge those exorbitant premiums anymore. It's a return to reality. So, when we zoom out and look at the full year of 2025, how did the company do? Total revenue, $88.7 billion. Operating profit, $7.9 billion. And here's the number dividend investors care about. Diluted EPS totaled $6.56. Did they generate cash? Yes. Cash from operations was a massive $8.5 billion. And what did they do with that cash? They didn't just sit on it. They returned $6.4 billion to share owners through dividends and share buybacks. This is the seed to wealth philosophy in action. We like companies that respect their shareholders. If they can't find a way to grow the business by 20%, they should give the cash back to us so we can invest it. And that is exactly what UPS is doing. Speaking of getting paid, they declared a quarterly dividend of $1.64 per share. That is payable on March 5th, 2026. If you want that check, you need to be a shareholder of record by February 17, 2026. Mark that date. Now, let's look forward. What does management think will happen in 2026? This guidance is crucial because it sets the expectation for the stock price for the next 12 months. They expect 2026 revenue to be approximately $89.7 billion. Let's do the math on that. 2025 revenue was $88.7 billion. 2026 forecast is $89.7 billion. That is a growth of roughly 1%. I want to be real with you. That is barely growth. That is essentially flat, maybe even losing to inflation. However, look at the margin guidance. They expect adjusted operating margin to be approximately 9.6%. In 2025, the adjusted margin was 9.8%. So they are actually forecasting a slight compression or staying flat on margins. They are planning capital expenditures, CapEx, of about $3.0 billion. This is money spent on new trucks, automation, robots in warehouses, and software. And they plan to pay out $5.4 billion in dividends. Think about that ratio. They are spending $3 billion on the business and giving $5.4 billion to shareholders. This confirms UPS is in the cash cow phase of its life cycle. It is not a high-growth tech stock. It is a utility-like machine designed to pump cash into your pocket. So what do we do with this information? If you are looking for a stock that is going to double in 2026, UPS is not it. The revenue guidance of 1% growth confirms that. However, if you are worried about a recession or you are building a passive income portfolio, this report is actually reassuring. Despite a drop in U.S. volume, they maintained their pricing power. They are clearing out old assets like those MD-11 jets, and they are committed to handing over $5.4 billion in dividends next year. The red flag is the U.S. consumer. The volume drop tells me people are tightening their belts. If that trend accelerates, if volume drops 5% or 6% next quarter, UPS will struggle to raise prices enough to offset it. My takeaway, this is a hold or a defensive buy. It's a boring, reliable compounding machine, but keep your eye on that U.S. volume number in the next quarter, Q1 2026. If that turns positive, the stock will soar. If you want to know the true health of the global economy, don't listen to the politicians. And honestly, don't even listen to the Federal Reserve. Watch the boxes. If it drops further, we might see a better buying opportunity at a lower price.